Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about inflation, mortgage rates, and what happens to housing if we do see a mass deportation of construction workers. As always, I want to thank our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here, Sarah. How are you doing?
I am doing great. It is CPI day. That's always interesting.
It is good. You know, the CPI inflation report was okay. Of course, rents are being very sticky, and the Fed doesn't move off CPI inflation; it moves off the personal consumption expenditures. But the 10-year yield fell right away, and then it just bounced back up. So we're here testing that one key level again. We're fighting back and forth, and we'll see what happens. But it does lead to our main topic today. Are we going to get another early spring 2025 demand run starting from mid-November?
You know, this is one of the most unusual things about the last couple of years, right? And where we saw demand pick up, and you can start seeing it now, right, in the forward-looking data, and then it really starts to hit where most people see it in February and March. So, what do you think, Logan?
You know, one of the things about this post-COVID world is that every single year has always had a late in the year demand run. 2020 was obvious. It was the makeup demand. COVID, everything stopped for a few months, and then it just filtered itself toward the later months. That could be explained. 2021 was odd because that was an authentic volume push late in the year. Rates had gone lower. But the last 2 years, 2022 and 2023, what has happened is, for people who didn't follow us, October 27th, 2022, we wrote an article, The Case for Lower Mortgage Rates. Back then, and the reasons are the big key here, the world markets were in disarray. The dollar was too strong. London was going to lose their pension funds. The IMF was going to send Ethan Hunt to get, to take out Jerome Powell because the Fed was raising rates. The world banks were mad at the Fed for raising rates too much. In any case, there was so much drama that the 10-year yield is going to, the next move down is going to be getting mortgage rates lower. So we're going to test, the first time we're going to test the forward-looking demand run. That in itself changed the housing dynamics. Rates went lower. We had 12 weeks of positive purchase application data. We don't count the holidays, people. Let's just hopefully, after 13 years of trying to explain this, we never count Christmas week, New Year's week, or Thanksgiving. You take that out of the equation. It was the best forward-looking demand run of the last few years. We get 500,000 home sales in one print. That was like one of the biggest month-to-month sales prints ever. And then rates went up. We tested the Gandalf line, right? We said 3.37. This will hold. 8 times it held. Rates went up. Housing demand went lower. That was it for 2023. Then last year at this time, different reason. The Fed basically signaled that they were done hiking rates. The 10-year yield was at 5%, 8% rates. Housing demand was slowing down. The builders were in trouble. Well, the history of economic cycles, whenever the Fed market believes the Fed is done raising rates, there's usually a huge rally in the bond market and mortgage rates go lower. But this time, only 8 weeks. We went from 8% to 6.63% at end of last year. In 2022, we went from 7.37 to 6. So the demand curve that we see that is more noticeable is when we get near 6%. But we had 2 good months of home sales, roughly 500,000 in those 2 months out. Then rates went up. So the question is, what's going to do that right now, right? What's going to lead us? Because if it is true that things have changed and people start to fill out their purchase application data a little bit earlier, then over the next 6 to 7 weeks, we should see just the sheer size of people applying for the spring. We'll have it grow just a little bit. So I think this will be a good test case because right now we're at a key technical level. If rates do fall down, and we have seen that 6%, getting towards 6% does change the demand curve. We can grow sales. Does this happen for the 5th time, during this 5-year period? And what does it tell us about the spring demand? Or Will this be different? Rates go up or stay elevated. There's no lower rates. And we just don't see that push until usually it's after the second week of January to kind of like the first week of May. That's the seasonal rise in purchase application data. Nothing has been seasonal with housing data in terms of that. That data line has been absolutely like crushed. And I've personally made a lot of adjustments to try to get ahead of it. But it'll be interesting to see for spring 2025 because our pending contract status are still showing year-over-year growth. It's slowed down. The tracker was a bit weird last weekend, but again, when you're working from the lowest level of sales ever, and it's the third calendar year, but jobs are growing, populations are growing, households are forming, does the sheer size of just having a little bit more people give you a little bit of kick into 2025?
So this is the question. So what you're saying is like, yes, we saw when rates went down, but how far do they have to go down to really spur this kind of thing? And what are the chances that that's going to happen now?
Well, here's one thing. Last year, rates went from 8.03% to 6.62. So we had positive forward-looking data with rates at 7.75, 7.5, 7, higher than what it is right now. That's why I find this to be interesting, because we already had the lower mortgage rate move already. It already filtered into the positive. Now, purchase application data came out today, positive 1% week to week, or positive 2% week to week, positive 1% year over year. But we're going to see what happens toward the second half or the last 6 weeks of 2024 going into 2025. If rates just stay here, there should be a little bit better demand, because that's kind of what we saw last year with higher rates.
So playing into all of this, is I know that the CPI data isn't as important as some other data, but when we look at like, are we going into a recession or not? So one of the things in the campaign that we heard towards the end there was like, well, there needs to be some pain. I think it was Elon Musk said, there's going to be some economic pain to get to where we need to go. So the question people have is like,
you don't need to listen to Elon Musk. Yeah, nobody's going to inflict economic pain. Listen, I hate to break it to everybody, but politicians or political economic people talk a lot, right? And nobody is going to try to inflict enough damage at this point with the labor data slowing down to put us into a recession, because then those people will be blamed. And then that's why midterm elections happen. And typically the people in power tend to overplay their hand. So it doesn't necessarily work that way. You have to go through Congress. There has to be an all approval. So whatever Musk says, just kind of leave it alone. There's no sabotaging President Trump under him. Trump wouldn't allow him to even do that. So economic pain for spending less, our state budget's going to get hit a little bit. Whatever that is, it takes time for that to process itself out. And we'll know ahead of time what we can model out. But we have to be a little bit skeptical on certain characters, maybe over exaggerating what they think they have power they can or can't do.
it will be interesting to see. As everything with the Trump presidency, just like last time, it's like there are the normal rules of the road, and then there's the things that are kind of a total crapshoot. So I agree with you. That's normally the case. We will see what that looks like here. I don't know that you can always say, "Oh, this is how things operate."
Here's the general thing, and we've talked about this in other podcasts. Let's just talk about the economic cycle in an expansion or recessionary, because if you use the word strong or anything like this, then everyone's ideological takes get into it, and it just becomes like a Bosch painting. It's just madness out there. So what we traditionally see is that residential construction workers and manufacturing workers tend to lose their jobs beforehand. Job growth has slowed down. It slowed down right exactly to what my forecasts were. It took the revisions to get us there. But the next leg would mean jobless claims rise. And Sarah, since 2022, we said, let's not go into the R word until we see jobless claims rising toward 323,000 on the 4-week moving average. And that works with every economic cycle we've seen post-World War. That's how models work. So there's going to be a lot of noise. There's going to be a lot of promises on doom or whatever. But let's stick to the data that we know we can trust. And what we can trust is that 6.75 to 7.5% mortgage rates makes it difficult for the builders to do this. One of the things that is a little bit concerning to me is that wage growth is actually staying a little bit more firm, probably to what the Fed doesn't want to see. The Fed wants 3% wage growth. Its last print was 4%. That probably gets revised a little bit too. Wage growth getting toward 3% makes them feel comfortable because that means shelter inflation can't really grow as fast. You can't have rents really take off if wage growth is decelerating. It has to be a natural equilibrium. That's something to think about in 2025 if wage growth starts to pick up again, and we're obviously housing permits are at recession levels.
So we've been talking about the R word, recession or expansion in the larger economy, but obviously people in housing and the housing industry has been in a recession since 2022. What do we see with, looking at this inflation report, thinking about the jobs where they are? Where do you think mortgage rates are going, which is so key to whether the housing industry is in a recession or not?
Okay, so what's our marketing theme? Paper, rock, scissors. Labor over inflation. So what brought rates down towards 6% in the end of 2022 and early 2023 and the mid part of 2024? Number one, the spreads got better this year, but it was the labor data getting weaker, right? We saw the revisions go lower, and then we saw a few of the prints. So I know a lot of people say, well, it's 12,000. Well, the Fed, the bond market kind of looked past that. Labor data getting weaker means jobless claims start to rise. There's your labor data is telling you we are in a bad spot. So we saw that at the end of 2022, where the market thought we were going to recession. They were pricing that in. So this is one of the things where I think a lot of people are listening to people who don't track economic cycle stuff, and they're telling you what you want to hear. Because people say, well, the economy's weak, mortgage rates have to go down to 4 or 5. Listen, the bond market wants to take it lower, but they needs to have the economic data to verify. It's tried now 3 times to kind of push down to the levels that I thought they could only go into. And every time it held, Gandalf held, Hodor held, right? Because we're not breaking. So labor data has to get softer, but the jobless claims data got better the last few weeks. Unemployment rates at 4.1%. Consumption in the GDP level is still sustainable for growth. So you need to grow below trend in labor data, and then you can have rates stay lower and stick. Now, can the spreads get better in 2025? Yeah, I mean, I got to tell you, man, if the spreads did not get better this year, we're north of 7.5% today. And nothing good happens with housing in that regard. So we can get better spreads and some softer in the data. And as the Fed starts cutting rates, the CPI report today is good enough for the December rate cut to happen. But again, labor, right? If that data starts to get weaker on the jobs reports and wage growth slows down and jobless claims start to tick up, there it is. That's what works. Forget about anybody's ideological takes or what some person says about the economy. That's what works. And then we'll see the data weekly with claims. We'll read the jobs report. We'll try to get of it. The one thing that's more concerning this time around than the last 2 years, manufacturing data is getting softer. And also residential construction workers are more at risk here because we're finishing all those units that are being built that were started 2 years ago or 12 months ago. They're starting to be done. Once that is finished, and if permits aren't growing, you start to lose that. And that's the first wave of the labor data getting weaker. And that is, in a sense, for everyone listening that's in the industry, that's what pushes rates lower. The housing disproportionately benefits in a weaker economy, but we're just not quite there yet. And that's why the Hodor line held. That's why the Gandalf line held last year. And then we're now taking it into 2020. This is why I'm really excited about the next 6 weeks to see, does 7% rates, because 7% rates did boost the demand last year because we were working from 8 down to 7. People said, I'm coming in. Let's see if that is the case again, because our pending contract data is still showing year-over-year growth. There's something there that's a little bit different than what we've seen in the last 2 years for sure.
Okay, so a couple of things. First of all, we've had several people reach out and say it's not Hodor, it's Hodor. So
I
hold the door. And what they don't know, Logan, is
I'm going
that
to
you
call it
mangle
whatever I'm
words.
going to call it. Okay. All right. It's my thing. I know. Hold the line. Hold the line. Okay. For those who don't realize, I'm taking the Game of Thrones character because he was holding the door, and I'm the economic hoarder on the bond market. We're holding it because the labor market isn't breaking.
Okay,
Similar to
but
Gandalf in 2023 or the 3.37 line, you shall not pass, right? The labor data needs to break. You know what happened, Sarah, is that the 10-year yield got to 380 around toward the end of December, and I didn't have a character. And I just say, well, the 380 level is going to hold, but it just didn't feel the same. So I was like, next time it happens, I got to create a Kai. So that's how I got Hordor. So everybody could kind of visually think, okay, labor needs to break for this. And what we saw
so
this year is that it took 3 really bad jobs reports and jobs a week to push us under there. And then that kind of reversed because a lot of the economic retail sales, all these things kind of beat expectations. The city surprise index rose. Oh my God, shocking enough, the 10-year-old rose with it. And that's how it's worked for the past 4 years. So we're
okay,
trying to
so
explain these things. I think fictional characters kind of make it easier than me just saying, oh, the 10-year-old's at 380, that level is going to hold. So
no, I think it's brilliant. It's one of the things I love about you. But let's go ahead and say Hodor and not Hordor, right? I mean, do you want to be Hordor? No, you
I
don't.
am going to call it what I call it because I'm the chart daddy, and the chart daddy gets to do whatever he wants.
Okay, see, this is what our listeners don't understand is that Logan will do this and it does not matter what I say.
Do
So,
I seem like the person that will allow anybody to tell me what to do? Do I have
no.
I ever given you that impression that I will just basically listen? Now, if you ask me nicely, Sarah, I will listen to you, right? But
Uh,
Chart
okay, well,
Daddy does it his way for a reason. There's
okay, well,
nobody in this country or planet Earth is going to go head to head with me for a reason, right? We do it to win, and I'm calling it Hordor.
okay. So, listeners out there, you've heard that from them. Don't keep telling me like, "Hey, he's saying it wrong." Yeah, I know. Oh, you can tell he doesn't care. Okay, so another question I have is that um, I know you don't want to, you're like, let's not talk about the politics of it, but we're talking about residential construction workers. And there is a strong push that as soon as Trump is in office, that he's going to deport a lot of people who might be here illegally back to their countries. We know that there is a large proportion of the residential construction workforce that might affect. So how do you work that into your model?
Are we going to name them quiet quitters again? Because you remember when nobody could find labor and everyone is like, quiet quitters. Nobody wants to work anymore.
No, we're going to label them the fact that there's going to be less residential construction workers, but it's not going to be necessarily for the reasons that you normally have in your model, which is that there's no work for them. It might be because they're not here anymore and they got deported.
Okay, so one of the things is residential construction workers. A lot of them, will be in the category. We've seen some of that in Florida, I would say. Um, it becomes more of an issue if sales are starting to grow. So I'm going to give you a hypothetical theory here. I'm not going to do the political economic theory, but a hypothetical theory with the labor force. Let's assume a portion of the workforce that is in construction is gone. Then all of a sudden rates fall, right? And then we need demand to build stuff. I would say that there's going to be parts of the US that's going to have a harder time finding labor. And then I'm going to tell you, they're going to say quiet quitters. Because this is what we do in this country. Literally, we were the only people on planet Earth that said job openings are hit the 10 million. And why did we do that? Because May 21st, all of you could go back and read that article. It was a one missed report. We still had job growth. And it was like, nobody wants to work anymore. And we're paying people to stay home. I was like, the stimulus checks were gone already. What are you talking about? Labor force growth is, job openings are going to get to 10 million and it's got to 12 million. Population growth, birth rates, deaths. I had this conversation today on Twitter. In 2022, 3.3 million people died, right? Where birth rates are right now, last year is 3.5 million. Babies can't work. But as you age into a demographic pool, you need younger people to replace them. There are parts of the US that do not have a very high growth of young labor force growth. So in certain pockets, if that was to occur, let's just say there is a deportation of construction workers, then you're going to hear people complain that nobody wants to work, because this is what we do in this country.
No,
Labor force growth.
I think this time people are going to know exactly what it is. Last time it was because, you did have a lot of things change with the pandemic. This one is going to be very much, I think, top of mind for people.
I would think if demand starts to rise again for the builders and construction workers right now, because permits are at recession levels and housing starts are at recession levels, it won't be an immediate issue. But I think when you're going out, the unfortunate reality is that construction productivity has been terrible post World War II. It's one of the charts I hate to put up there, but it does. You look at productivity, manufacturing, and art and agriculture, everything is growing. And then there's construction productivity. So the use of manual labor is needed. And also it costs more out there. So we will cross that bridge when we'll get there. If that does occur, if rates fall, demand picks up, and there are no workers, then we'll discuss what reasons are given at that point. But for now, because housing starts are at recession levels, permits, and nobody's been deported yet. By the way, one of the silly arguments, because you know what I do, Sarah, every single year I challenge the housing crash people to give me a reason, give me a price forecast and a reason. So some of the trolling men, God, some of you men literally wasted your life on social media. But one of the reasons people are saying, oh, home prices are going to crash because we're going to deport 20 million people. I was like, okay, if you deport 20 million people in 2025, that's like, I don't know, like 50,000 a day. That's some operation.
That'd be very efficient.
I mean, that's literally the operation wise. That's like, but you have to think about this. There is 337 million people in America, the population. That can't be your reason for home prices crashing, right? Because it's just, you're assuming that every one of these are working people that got loans and that, so in a sense, you're also taking your deportation model out. So your model's already messed up because these would be homeowners. So you're going to probably run into that by the kind of extreme, wacky anti-central bank people. They're going to say, we're going to deport 20 million people and home prices could crash. You kind of want to ignore that. That's cuckoo land. And these people have been in cuckoo land for 13 years. And we've labeled every single year for the great reasons. What was 2024, Sarah? Sexless men. The silver tsunami, credit card debt, higher mortgage rates, higher inventory, all that stuff happened. Home prices are actually probably going to be above my forecast in 2024. So our job is to teach economics, and if something happens in that regards, we'll connect the dots into there. But for now, one day at a time, one step at a time, we'll cross that bridge when we get there. But it can be an issue when rates fall, demand picks up, and some people say, I can't find labor in that regard. So cross that bridge when we get there.
All right. Well, thank you so much, Logan, for being on. We will continue this conversation in a few days. As always, thank you.
Hodor, hold the line. Say it my way.
No.